back into this ET Now special. You're watching our special coverage of the face-off between two market heavyweights. Commodity and market expert Jim Rogers has said he repents missing the bus when it comes to the Indian markets. The global guru admits he was too hasty when he exited India back in 2015. Do recall, at that time Jim Rogers had said the Narendra Modi government was only making headlines but not doing much on ground. Today Rogers says he lauds the same government for getting a lot of work done, including the GST bill. Meanwhile, Nilesh Shah of Kotak AMC has written an open letter to Jim Rogers advising him that instead of repenting, he should first return to Dalal Street. Before we get to Nilesh Shah, this is what Jim Rogers told ET Now.
Well, doesn't matter what I think. The facts are I did. You know, the market's gone up a lot. The currency's gone up and the market has gone up since then. What I was wrong was Mr. Modi had run on a campaign that he would do all sorts of things, and he had done all sorts of things before, but that he didn't do anything, you know, for quite some time, which I knew he knew what he was supposed to do. I was disappointed that he did nothing but talk. So I sold out. I should have been more patient. If he had told me he was going to get it done, I would have stayed around. It's not cheap. I don't like to buy things that are going straight up, making all-time highs. I've learned many times in my life that if you jump on a moving train, you're probably going to get hurt. Therein is the reason that I'm somewhat worried. I know that when lots of markets are making all-time highs, one should be worried. I own markets like Japan, China, Russia, markets which are not at all-time highs. And if the rally continues, I hope maybe I'll make a little money as well. But I'm not jumping onto markets at all-time highs.
So that's Jim Rogers also saying that he's wary of markets hitting all-time highs, even though he repents missing the bus when it comes to India. Nilesh Shah, the managing director of Kotak AMC and one of the most influential market voices that we have here in the country, wrote an open letter asking Jim Rogers to stay invested in India, that the markets are not expensive even at the current levels. And he joins us now in this ET Now special. Nilesh, we read your comments in the Economic Times today, so we decided to get you on the channel too. Part one of the story is when you say don't let go of India, and the second part you say why is it wrong to buy now even at all-time high levels. Have I got that right?
I have quoted in that article one incident of Sri R.K. Damani. When HDFC Bank got listed on stock exchanges, he was the big buyer of that stock. He kept on buying it at not only at high prices but also at very high valuation. And he kept on buying it to become the single largest individual owner of that company. Now, as per Jim Rogers' indication, he should not have made any money on HDFC Bank because he bought it at high prices, because he bought it at high valuation. Now, the fact remains that HDFC Bank has delivered fantastic return. The fact remains that R.K. Damani has made far more money than probably Jim Rogers has made. And it just shows that for every rule there is an exception. Maybe for all the rules in Jim Rogers' book, there will be an exception called India.
Okay, so that's an interesting lesson from Mr. Damani and HDFC that Jim Rogers can learn. Nilesh, you've also advised Jim Rogers that even now it's not too late and he can jump onto this running train. But you know, we all know his style. He's typically not seen as a long-term bull, so to speak, in any asset class. He's made a lot of money in commodities. He sees buys or sell opportunities and evaluates them on regular basis or short-term basis. Whereas your thesis is primarily and normally always on long-term investing and part of compounding. So there is a difference in the strategies that you and Jim Rogers follow. So given that, do you still think he should jump onto this running train?
Each one has to do what is suitable to him. And the intention of this letter is to just bring certain facts to his notice. He is far elder to me, and in terms of age as well as stature. So it's not to prove him wrong, it's just to prove what is right. So one of the contention in the interview is that India does not have open currency. Now that's not correct. Even in the depth of 2008, we allowed FIIs to sell and take their money home. We didn't behave like China, who in 2015 stopped people from selling stakes if they were owning above 5% in a company. They stopped people from selling when the markets were on the downtick. So when someone says, especially the foreign investor, that India does not have open currency, that's not appropriate. The open currency is not for Indian citizens, but for foreign citizens, for foreign investors, it is there. The second thing, when someone talks about India not doing enough on FDI, I mean, you look at the stories which are there in Indian market. When Maruti today has 1.5 times more market cap than Suzuki, this is despite Suzuki owning more than half of Maruti. Now, how can the success of Maruti not attract more foreign direct investors into India? So clearly there are certain misconceptions, there are certain myths about India in outside world, and it is our job as Indian fund manager to bring facts in front of them and then let them decide what they should do. Now, since the time I have been hearing Mr. Rogers, he has been bullish on gold, and I just did one small analysis on gold. So in last 10 years, September 10 to March 17, gold has virtually remained flat. That means by owning gold in US dollar terms in last 7 years, you haven't made any money. And obviously gold does not give any dividend, gold does not give any bonus, gold does not give any interest. Now if you had invested in Kotak Emerging Equity Fund, you would have increased your wealth by 190%. So clearly do what you want to do, but there are always options available, and we believe India is a long-term bet.
Okay, so if you had just bought gold, flattish returns, whereas they were invested in one of your funds, you talk about 190% return, also defending the Indian currency markets, that it's not as close as it's made out to be. Nilesh, I now want to talk about the recent rally. Investors clearly happy with the ongoing bull run, but ultimately, we've always seen the law of averages come into play. Law of averages turns out to be supreme. So do you think India will not be anything special going forward thanks to this recent bull run?
Undoubtedly, law of economics remain the same, whether you are white country or you are a brown country. India is no exception to the laws of economics, but we are at a stage where we will be able to outperform the market. We will be able to outperform market not because we are smart, but because of the nature of India. Today's index represents the past performance. Companies which have become big, they have become part of the index. But tomorrow's India is being built in a separate industry, in a separate sector. Those companies we can invest into before they become part of the index, and hence our performance as a fund manager can be superior to index. If we see an average gilt fund's performance over last 18 years, that has outperformed in US dollar terms the God's company Berkshire Hathaway. Now, how can an ordinary fund manager of India, and that also in fixed income, deliver better return than God himself in US dollar terms? And the God uses derivatives, leverage, shorting. The poor Indian fund managers doesn't do anything. It's not that we are smarter than Warren Buffett. It's just that we have got right platform in India where we are able to participate in the future growth story. So all I am saying is that India is a long-term prospect. If you pick up right stocks, you will make money. And of course, equity has its own volatility. I'm not at all saying that markets cannot correct from current level. Of course, it can come down, but you have to buy at every level of the market, and that's how you make money over a period of time.
Okay, so you have to buy at every level of the market to make money. Nilesh, I'm going to now, when I wrap up this question, I'm going to ask you that if you are to write an open letter today, not to Jim Rogers, but to any other investors who has a genuine 5-year horizon, who are confused whether to buy gold, which you have pointed out in US dollar terms as being totally a flat investment, or equities, then how should they balance it out? And also, let's not forget the other asset class, real estate. How should one allocate funds?
if I have to write a letter to Indian citizen, my recommendation will be to avoid buying gold, primarily driven by three facts. One, as Indians we already own more than enough gold. We don't even know how much gold we own because a lot of the gold is unaccounted for. Now as a country, India cannot afford buying gold unless until you are sure that all the currencies of the world will be gold benchmark, or all the countries of the world will follow gold standard. I don't think so gold standard is coming, and hence as Indians we have more gold than necessary. The second thing is from a return point of view. Gold obviously has almost dropped 40% from high, so to that extent there is limited downside. But in Indian equity we believe there is better upside, despite the fact that markets are almost at all-time high level in terms of numbers, not in terms of valuation, and there will be volatility ahead. But if you take a 5-year view, and if you are going to invest systematically and in a disciplined manner, I'm sure Indian equity and Indian equity mutual fund will outperform gold. So whether you look at from a country point of view or whether you look at from your personal point of view, Indian equity provides better opportunity than gold over a period of time.
Stay away from gold. Indians already have enough gold. What about real estate? What would your approach to real estate be? Indians are also obsessed with the property market.
Real estate again is location specific. There will be locations and projects which will make return for the investors, but on an overall basis, if we see real estate is passing through the consolidation phase, so if you pick up right location and right project, there is a good chance that you will make money which will be comparable with equity. But if you are stuck in a wrong project and a wrong promoter, then you will have a tough time. And we have started seeing in real estate sector where many companies are unable to deliver on their promises, and investors who have invested their lifetime saving for 5 years and 7 years and 10 years are still not able to see any appreciation on their portfolio or their home which they had booked. So in real estate, be very, very selective, be very, very choosy.
So be selective about real estate. Of course, it's all about location, location, location. We often tend to forget that. Nilesh Shah, always a pleasure talking to you. Thanks so much for joining us here with your outlook, your trading ideas, and being so candid about where Jim Rogers went wrong and where other global gurus also go wrong. With that, we'll wrap up this 18-hour special. Many thanks for watching.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.